Walgreens is down 67% in the past 5 years. They are reporting earnings this Thursday, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, we can see that this is not a fast-growing company. However, they are still growing, as they reported 9% revenue growth in the last 2 quarters, and analysts are expecting them to grow at around 4% over the next 5 years. On the other hand, their profit has taken a big hit. Free cash flow going from $5.2 billion in 2020 to negative $500 million currently. This is why they had to cut their dividend in half, as dividends come from free cash flow. However, they are expected to get back to profitability in the upcoming earnings and make 85 cents per share. In this regard, analysts are expecting them to make $4.50 in 2028. If you assign a 10p to the company then, it would make it a $45 stock, meaning 125% upside returns. Then, in order to calculate the intrinsic value of the company, I used my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. These numbers mean that in order to make the desired annual return that I have put in, which is 15%, you need to pay these prices. I went with 15% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. The stock is currently trading at $20 per share. Therefore, if the low assumptions occur, you are going to make a 20% annual return on your money, middle 35%, and high 50%. For my revenue assumptions, I did 1% annual for my low, 3% on the middle, and 5% on the high, which is around what analysts are expecting. I assumed a profit margin and free cash flow margin of 2% on the low, 3 on the middle, and 4 on the high, which is what they were doing before this drop in profit. I believe profit is going to get back to where it used to be, as this is one of the main priorities of the management team with the Transformational Cost Management Program. The program focuses on improving its cost structure and balance sheet. I assigned a P and price to free cash flow of 8, 10, and 12, and left the share outstanding change at 0%. However, they have been buying back some shares over the past years, and if we consider that they buy back 2% of their shares annually for the next 7 years, the valuation becomes even more attractive. These returns include the dividend, which is currently 4.8%. Google Sheet does not take into account the balance sheet of the company, and Walgreens has a lot of debt as they have $780 million in cash and $33 billion in debt. However, they do have a lot of leases. Companies like CVS and Target also have a lot of debt. In the fiscal year 2023 report, we can see that the largest debt repayment occurs in 2026. This is favorable for Walgreens because the Fed is expected to cut interest rates, and therefore the refinancing rate will be favorable. In conclusion, I think that if Walgreens can go back to the profitability they had before, it's going to lead to very good returns. The valuation looks very attractive, as we have seen on the spreadsheet, and the forward PE of 6 and price-to-book ratio of 0.9 are metrics which are at a 10-year low. However, there are also some risks, in my opinion, the biggest one being Amazon Pharmacy, which could take Walgreens or CVS out of business. I hope you enjoyed the analysis. Let me know what you think about Walgreens in the comments, and I'll see you in the next one.